I'm recording this video before the new bank balance sheet data, so I want to keep it focused on the stock market. And I want to let you know that that's simply where we're at in the cycle of data and this video recording. So, the market had a red day today, pretty much across the board. Was it a break? Well, it's too early to say it was a break. We do need a little bit more follow through here. We got some pretty important data. We got some pretty important Fed speak. And I think we should interpret this in the context of where we are in the stock market. So let's start with the Fed speak. We got Michelle Bowman, over in Europe, which I believe if you watched yesterday's video, you'll know my interpretation of the European Central Bank is that they are quite hawkish. So I don't know if this is a coincidence or if this is a planned operation that she is speaking with the European Central Bank in Germany, talking about how she's, and this is the first Fed member, I believe, to directly address the most recent CPI report. Waller didn't address the most recent CPI report. Kashkari didn't address the most recent CPI report. But Michelle Bowman talked about the most recent CPI report and said that it's not necessarily conclusive that inflation is on a downward trend. And why would she say such a thing? She's saying such a thing because the Fed cares most about core inflation. And if you look at core CPI, the last four reads of that to start the year, the four reads of the year are 5.6, 5.5, 5.6, and 5.5. That is very much a flat number. Let's not forget, last year's numbers were rather volatile because they are based on comparisons to the year before. And the year before was uneven with inflation. It was the early stages of inflation. So this year, core inflation being quite flat, I think is somewhat notable. Yes, it does indicate a plateau, but it's a plateau at a very high level. Let's not forget, last month's month-on-month core CPI, which I believe was 0.4%, that's a reacceleration. And that's not particularly cool. That is 4.8% inflation. And the Fed's not trying to get to 3.5. They're not trying to get to 4 and then change their tune. They're trying to get to 2. And they're trying to actually get to 2. If they were not going to get to 2, they would have let us know by now. It seems that Michelle Bowman and Goolsbee today, are saying the jobs market is strong. Michelle Bowman actually said the jobs market tightness is not indicating that the fight is over. So the way I am seeing the inflation picture now is we are meaningfully away from 2% on core. Downward trend is not confirmed because we've had such a flat core CPI so far this year, four reports in already. And the labor market is strong. So they have plenty of ammunition to keep firing. Now, the market is obviously pricing and fighting them based on the banking stress, but we've seen the financial stress indicators. They're not necessarily screaming of anything. They're really just not notable. Yes, SVB did peak them a little bit, but it wasn't too high relative to history, and it wasn't really that far out. We actually were negative just a few weeks later in financial stress. So I think some banks can fail. I think that was an expected outcome of the Fed. If you've been watching these videos consistently for a long time, you know that months ago, I believe almost 6 months ago now, we saw Michael Barr talking about how they were going to re-examine capital requirements for smaller banks and non-bank financial institutions. This was very much on the Fed's radar, the possibility this would happen. They did record hiking cycle, more aggressive than right before the 07-08 financial crisis. So they're not necessarily hedging their bets more than they have to. They've done a lot, and we haven't seen the kind of progress on inflation that they're looking for, and we haven't seen the kind of deterioration in the labor market that they feared. So the whole logic, sorry, there's a beat. I'm going to scare it so it doesn't park up, build a nest near my house. The whole logic was, the economy is going to crash and the Fed is going to have to pivot. Well, it doesn't seem like that is how they're reading it. It seems like how they're reading it is inflation is too high and we haven't said we're done hiking yet. Now, they haven't said they are going to hike yet. They're probably not going to because we're going to get June CPI data right before the next Fed meeting. And they probably want that to confirm their intentions. But based on the dialogue I'm seeing, we have erased the need to qualify the last CPI report as some sort of definitive pause or leaning in the pause direction. That is not the vibe I'm getting yet. Obviously, things can change. There's definitely more data to come. But to get all bulled up based on the last CPI report, I think is a little overdone. And since that CPI report, we've actually gone lower. And that day, we actually went lower for the S&P 500. And we're just turning around in a flat range. But what is leading us to think possibly the beginning stages of a break is mega cap tech doing weak today. Rates being higher today. Those are the two things that have not occurred thus far. And obviously the rates picture, it's not a lot. It's something. We obviously had a bigger pullback this week in rates. But it's moving in that direction. If that continues, that's the market. That's the situation. Risk-free rate of return going up. Also, possible risk in the so-called risk-free with the looming default situation. Not saying it's going to happen, but it's looming. So, not a break yet. It's hard to announce that kind of thing yet, but we should not be surprised if it occurs, is my point. And I've also shared with you my interpretations of the Fed and their interpretations, at least what they said, about the most recent CPI. So take all that into context when making your decisions. I appreciate you coming to this video. Have a good weekend. And until next time, peace out.